In most cases, corporate tax incentives left states in worse financial condition than they were to begin with. That's the finding of a study published recently by the journal Public Administration Review. The study looked at the relationship between financial incentives and the fiscal health of 32 states, including Connecticut. Bruce McDonald, who is one of the authors, says the peer reviewed study examined how incentives have influenced the financial condition of the government and its ability to keep providing services. While the study was published before Connecticut passed legislation providing long term tax breaks to data centers, those types of tax incentives were part of the research. And so, what was the key finding that you got from this study?
The findings were really twofold, that some types of incentives do improve the financial condition of the government, that essentially there's a positive relationship between the economic growth that businesses bring that comes out of those incentives with the financial condition of the state. But most of the time, whenever we offer incentives, it actually decreases the financial health of the state. So as the incentive goes up, the state actually becomes less financially healthy and less stable overall.
What kind of negative effects do you mean when you're saying over the long term it's bad decision, bad policy of the state? What are we really talking about?
Right. So when we think about negative effects, we're thinking about the impact of certain types of incentives. So R&D incentives, property abatements, or just general investments that are incentivized have a negative impact on the fiscal health, which essentially means that we're moving resources from the state that the state can then use to help benefit the general public. So we're either having to raise more taxes in order to help cover those costs, or having to make cuts in the services elsewhere. So while we might have some positive aspect from that business coming in or that business expansion, the ultimate consequence and its impact on individuals within the state might not be that positive. We might have less funding for libraries or universities or after-school programs, for example.
Were there circumstances that you saw where incentives did work for a state?
Sure. So thinking about what kinds of incentives work, we found that incentives related to training and employment had positive impacts on the state's financial position, specifically job creation tax credits and job training incentives. So when a business was able to receive those credits, it essentially moves people from unemployed or underemployed into better positions to become more positive contributors back to society, which then allows them to start paying taxes at higher rates, which then benefits the community as a whole.
Connecticut was one of the states that you looked at. Did anything stand out about that state specifically to you?
So Connecticut's interesting. They have 4 of the 5 types of incentives that we looked at. They have job creation tax credits, investment R&D, and property tax abatement credits. They don't have the job training programs going on that are funded as an incentive type of plan. The job creation tax credits are actually relatively new to the state. They've only been taking place since 2006. Rather, the state's been fairly heavy in property tax abatements and R&D tax credits, which those are 2 of the really, really big ones that have negative consequences on the fiscal health. So there definitely is some positive aspect that's going on in Connecticut from the investment side about that job creation, but the positive side is being outweighed by the negative that's coming from the R&D and the property tax.
What about the argument, though, that a state could build an industry there, so an insurance industry, a tech industry, so it's not just a one-off company, but that there's a plan to build an actual industry in the state?
The industry definitely comes in and it provides a large contribution in many ways, but on the other hand, it also comes with consequences. When the cost of housing starts to go up, the demand for services and expectation of services has shifted in those communities. The nature of who lives there and who can even afford to live there has dramatically changed. It's definitely nice to have kind of a core set of industry wanting to be in your community, but there's definitely consequences that come with that. And we have to make sure we kind of think through, is that something we really want? A number of states have kind of started pushing back against incentives, that we can keep offering them more and more at higher and higher rates. The problem is that they don't necessarily bring back as much to the communities we might like to see. And it has become almost to the point where some states can't afford to keep engaging in that behavior, or that the levels of incentives needed to bring somebody in is too high for a state to be able to afford. Because ultimately, A business is going to go to a community regardless of what the incentive is itself. Amazon HQ2 is a perfect example of that. New York and Virginia definitely weren't the most attractive from the incentive standpoint, but that's where Amazon picked because that's where Amazon wanted to go. We can offer all the incentives we want, but they're going to choose where they want to move, if that's in our community or not, hopefully based off of how well our community is and how great of a location it is, not necessarily because of that incentive itself.
Reporting for CT News Junkie, I'm Adam Chiara.